How to survive and get rich during a recession. Did you know that more millionaires were created during the Great Depression than at any other time in American history? While millions lost everything, a small group of investors quietly multiplied their wealth by 10x, 20x, and even 50x. This counterintuitive reality reveals the secret that most financial advisors won't tell you. Recessions aren't wealth destroyers, they're wealth transfers. Have you ever noticed how the ultra-wealthy seem strangely calm during economic meltdowns? Why aren't they panicking like everyone else? What do they understand that most people don't? Imagine two neighbors facing the 2008 financial crisis. Both started with similar jobs and savings. By 2010, one had lost his home and half his retirement. The other had doubled his net worth and acquired 3 rental properties at fire sale prices. Same economy, drastically different outcomes. The difference wasn't luck, it was strategy. The economic warning lights are flashing right now. Inflation is surging, interest rates are climbing, and the yield curve has already inverted. These are the same signals that preceded the last 7 recessions. The question isn't if a recession is coming. It's whether you'll be among those financially devastated or those who leverage it to build extraordinary wealth. What I'm about to share isn't the standard cut expenses and hold cash advice that saturates financial media. These are the actual wealth-building strategies that the top 1% deploy during economic contractions. Tactics that most financial professionals either don't understand or deliberately keep from their clients to protect institutional interests. Think of a recession as an economic forest fire. Destructive? Absolutely. But just as forest fires clear dead undergrowth and create fertile soil for new growth, economic downturns clear inefficient businesses and create once-in-a-decade opportunities for astute investors. This natural cycle has created more financial windfalls than all bull markets combined. In the next 10 minutes, I'll reveal the exact 7-step framework that has allowed me to not just survive but dramatically grow wealth through multiple recessions. You'll learn how to build a recession opportunity fund, identify counter-cyclical investments, and develop the psychological fortitude that separates those who profit from those who panic. Hit the like button right now and comment, "Recession ready," if you're committed to turning the next economic downturn into your greatest wealth-building opportunity instead of a financial disaster. Your comment helps this critical information reach others who need it before the economic tide goes out. Number 1. The misunderstood truth about recessions. Most people fundamentally misunderstand recessions. They view them as aberrations, rare economic diseases to be feared. The reality is far different. Recessions are as natural to economies as winter is to seasons. Since 1945, the US has experienced a recession approximately every 5.5 years, lasting an average of 11 months. The first principle of recession-proofing your wealth is accepting this inevitability. When you understand that downturns aren't if, but when scenarios, you shift from reactive to proactive financial planning. Here's what most financial advisors won't tell you. The wealthy don't merely survive recessions. They actively prepare to capitalize on them. They understand that while the majority panic sell at the bottom, the real money is made by those positioned to acquire assets at historic discounts. Number 2. Liquidity is oxygen during economic contraction. During the 2008 financial crisis, when the market had fallen over 50% from its peak, most investors were paralyzed, not because they didn't see opportunities, but because they lacked liquidity. Meanwhile, I was able to invest $5 billion in Goldman Sachs with terms so favorable they're still studied in business schools today. This leads us to the first actionable strategy: building a recession opportunity fund. Unlike a standard emergency fund, which you should absolutely have, this is capital specifically earmarked for investment during market downturns. The ideal recession opportunity fund should equal 20 to 30% of your investment portfolio, held in highly liquid, low-risk assets such as treasury bills or money market funds. This isn't money sitting idle, it's ammunition waiting for the perfect moment to be deployed. The psychological advantage this creates cannot be overstated. While others feel fear when assets decline 30 to 50%, you'll feel excitement at the bargains becoming available. This emotional inversion is worth more than any stock tip. Number 3. Debt, the recession amplifier. Leverage is a dangerous magnifier during recessions. The same debt that boosts returns in bull markets becomes a wealth destroyer in bear markets. Consider two investors with $100,000 portfolios at the start of 2008. Investor A used 50% margin, borrowed money, effectively controlling $150,000 in assets. Investor B remained debt-free. When the market fell 50%, Investor A didn't just lose 50%, they lost 75% of their original capital. Many never recovered. My company, Berkshire Hathaway, has maintained exceptional financial strength by adhering to a simple principle. We never want to depend on the kindness of strangers to meet tomorrow's obligations. We operate with redundant liquidity, ensuring we can weather any economic storm while capitalizing on opportunities that arise. For individual investors, this translates to a simple rule: eliminate high-interest debt before a recession begins, and avoid taking on new obligations during uncertain economic periods. If you already have low-interest, long-term debt such as a fixed-rate mortgage, focus on building liquidity rather than accelerating payments. Number 4. Counter-cyclical income streams, your financial safety net. Most people depend on a single income source, their job. This creates extreme vulnerability during recessions when unemployment typically doubles from its baseline rate. The wealthy approach income differently. They build multiple, uncorrelated revenue streams that don't all suffer simultaneously during economic contractions. Some may even thrive when the broader economy struggles. Consider developing at least 3 distinct income sources before the next recession hits. Your primary career or business. Passive investment income, dividend-paying stocks, bonds, REITs. A counter-cyclical side business. This third category deserves special attention. Certain businesses actually perform better during economic downturns. Basic consumer necessities, discount retailers, home entertainment, affordable luxuries, and financial services that help people manage debt. One of my most successful investments, See's Candies, has demonstrated remarkable resilience through recessions. During economic contractions, consumers may postpone major purchases but continue to treat themselves to small luxuries like premium chocolate. This counter-cyclical characteristic makes such businesses particularly valuable during tough times. Number 5. The Investor's Recession Playbook, Sector Rotation. Not all industries respond equally to economic contraction. Understanding sector rotation during recession cycles can dramatically improve your investment returns. During early recession phases, defensive sectors typically outperform. Consumer staples, people still need food, household goods. Utilities, electricity and water are non-negotiable expenses. Healthcare, medical needs continue regardless of economic conditions. Discount retailers, as consumers become more price-conscious. As the recession deepens and recovery begins, opportunity emerges in high-quality financial institutions, available at steep discounts. Technology companies with strong balance sheets and essential products. Industrial companies positioned for the eventual recovery. The worst performers are typically consumer discretionary goods, luxury items, travel. Highly leveraged companies regardless of sector. Companies without clear competitive advantages. This sectoral understanding allows you to not merely defend your portfolio during recessions but to strategically reposition it for maximum advantage during the inevitable recovery. Number 6. The Circle of Competence. Stay within your knowledge base. During recessions, desperation often drives investors toward unfamiliar assets or strategies. This is precisely when maintaining discipline becomes most crucial. At Berkshire Hathaway, we operate within what I call our circle of competence. We never invest in businesses we don't fundamentally understand, regardless of how attractive the opportunity might appear to others. For individual investors, this means resisting the allure of exotic, recession-proof investments being promoted by those with something to sell. If you don't understand how an investment makes money, how can you possibly evaluate its risks during economic stress? Your recession investment strategy should leverage your unique knowledge and experience. A healthcare professional might recognize value in medical companies that others overlook. A technology expert might identify which software services become more essential during economic contraction. Your professional expertise gives you an information edge. Use it. Number 7. Psychological fortitude, the ultimate recession asset. The greatest determinant of your financial success through a recession won't be your investment picks or even your asset allocation. It will be your psychological fortitude. Markets typically drop twice as fast as they rise. This acceleration of loss creates intense emotional pressure that clouds judgment precisely when clarity is most valuable. The natural human response, selling to stop the pain, is exactly wrong. To build psychological resilience, study market history. Understanding that recoveries have followed every previous recession provides crucial perspective. Practice decision journaling. Document your investment decisions and rationale before recessions hit, creating a reference point that isn't contaminated by in-the-moment emotions. Establish no-action periods. Commit in advance to minimum holding periods for long-term investments, preventing impulsive selling during market panics. Create decision rules. Predetermined guidelines for buying or selling based on valuation metrics rather than price movements. Remember my most famous advice: be fearful when others are greedy, and greedy when others are fearful. Recessions are when this principle becomes most powerful and most difficult to follow. History has consistently shown that more millionaires are created during and immediately after recessions than during boom times. The wealth transfers that occur during these periods are enormous, but they move in a counterintuitive direction, from the emotional to the disciplined, from the unprepared to the prepared. The strategies I've shared today aren't theoretical. They're the same principles I've used to build Berkshire Hathaway into one of the world's most valuable companies, delivering compound annual growth of 20% over 57 years through bull and bear markets alike. Implement these approaches before you need them. As the saying goes, the best time to repair your roof is when the sun is shining. Economic skies may seem bright today, but remember that the business cycle has not been repealed. Another recession is coming. The only questions are when and whether you'll be positioned to emerge from it wealthier than before. If you've found these strategies valuable, please share this video with others who might benefit. Leave a comment with your own recession preparation tactics, and subscribe for more investment wisdom that stands the test of time. Remember, in the world of investing, temperament trumps intellect, and preparation eliminates fear. Thank you for your attention, and I look forward to hearing about your success in turning the next recession into your greatest wealth-building opportunity.